This webinar represents a collaboration between AuditrNet and AuditSoftware.net in delivering training series focusing on audit software. We're really glad that you could join us. I'll be moderating today's webinar. A little bit about myself for those who don't know me. I'm the founder of AuditrNet with a background as a chief audit executive, Internet for Auditors pioneer, and an auditor who believes and promotes the use of technology for audit. The next slide provides you a little bit of information about AuditrNet. Before we proceed to today's material and introducing Rich Lanza, I'd like to just point out a couple of housekeeping items. We did send out these in the slides this morning. I'm not going to read them, but basically this says that we are recording the webinar and you will be provided with a link to the recording. We are complying with NASBA rules, and if you answer all of the polling questions during the webinar, you will receive a CPE certificate. So you must answer all the polling questions. Those of you who are joining us from a tablet device or an iPad, you may not be able to respond to the polling questions. If you would just accumulate your questions in one email and send them to us, we'll record them and you will receive your CPE certificate. The next screen, we'll also take questions during the webinar. There's a chat box on the screen. You can just fill in your question in the chat box. Also, there's disclaimers, and I'm not going to read the disclaimers, but please pay attention to them. And in order to provide the maximum amount of time, I'd like to turn the floor over to Rich to introduce himself to you and get into today's topic of sampling in Excel and other simple add-in products. Rich?
Great. Yeah, thanks again. Thanks again, everyone, for coming today. As to my background, I've been an auditor, an internal auditor for over 20 years, used data analytics to that end as well. And I've used sampling, but I do find that I run a lot more 100% testing, and we should talk about how that integrates with your sampling approach anyway, so we'll talk about that today. As to the learning objectives for today, I wanted to start out and try my best to explain and translate sampling theories and just in general terms, and then also kind of translate it down into Excel. Once we've done that, what we'll then do is talk about record sampling, which will kind of be done in more of a random and fixed interval sort of way, and then we'll kind of move on. That'll be done in Excel. But then we're going to have to, for monetary unit, move to an add-in called Active Data for Excel, and we'll show you that. And we'll also talk about stratified sampling, which you can do in Excel, but like I probably suggest you do it in Active Data because it's a lot faster. Then we will continue onward. That kind of gets us through the basic sampling, like what you normally would sample if you were doing a financial statement audit or a Sarbanes-Oxley control audit. But then I want to kind of move forward into what really works, and that's kind of where you get into scoring and doing things with z-scores and normal distributions and things like that. So that's kind of how we'll end the session. I do want to note this is a 2-hour session, and there are sampling courses out there. I know the IIA even has one, that go on for 2 days. So bear in mind we'll be going through this relatively quickly. It's not meant to be a full dissertation on sampling, but rather a very good quick summary and then how-to in Excel. So as to the sampling theories themselves, what I first want to do is kind of talk about how we can bring some of these theories into Excel. But let me kind of start off and talk in general terms about the sampling theories. Now, as to sampling, and I talked about 100% auditing, and I kind of started off with that. I think one of the first things we need to remember here is that if you can audit 100% of that transaction control or of that balance even, if you could literally map every one of those balances, let's say, to the cash receipts, and you had a separate file from the bank and it was totally independent data, and you matched all cash receipts to what the client said were cash receipts, I mean, that's 100% auditing, right? I mean, and then we're looking at exceptions, and maybe we sample the exceptions, and that could be something that's done. But I think we need to remember, if you can do 100% auditing, you should. And the standards say that, but I still don't see it as much, in practice, and at this point, I literally want to go to an article, so I'm just going to kind of switch gears here, but I just found this so compelling, and this came out, I think, just about a week ago or so. When something shows up in Forbes about auditing, I'm more interested. I know it is an opinion, of somebody, so it's kind of this Forbes opinion, and it's from KPMG. But it's really interesting how it kind of talks through, how auditing hasn't changed much in 80 years. I don't think sampling really has changed in the audit world in at least, what is it, 80 years. But then talks about how the future of auditing will then move to more of this data analytic approach, 100% auditing, big data, and that's where it's headed now. Like he really feels it's going there as opposed to not. I know we've had these discussions like 10 years ago. I mean, that article could have come out 10 years ago, but I do like the fact that it's in Forbes now, and it's not something we're just talking about, but happening more at like a Wall Street Journal-ish level. Okay, so I think with that said, let's kind of get into, we have to do a sample, and there's just too many transactions. We can't test them all. We have to look at manual documentation, so there's just no way around it. We can't do 100% auditing. That's where sampling risk comes in, and that's the risk that the conclusions reached by the auditor of that sample population will differ from the 100% testing of the population. So again, we talk about this 100% stuff. That's kind of, what would happen if we matched all cash receipts as opposed to sampling all cash receipts is the best way of looking at it. Then I just wanted to note, as I continue on in this, and what's really kind of cool is even the first book was actually translated into active data. So it's almost like if you buy this book, Sampling a Guide for Internal Auditors, it's sold by the IIA, and I could swear that it's actually on discount a lot of times because it's an older publication, but it works great, and something if you want to look into more on sampling, definitely look at that. AU Standard 350, I have a link there. That's the auditing standard for the AICPA. I'll talk about it today a little bit, but it's something to really go into it if you want to. And then New York State Society of CPAs has a great article on monetary unit sampling in Excel, and it really is sort of going to take a lot of time, so I can't do it today, as you'll see. But with that said, if you wanted to go back and like recalc, I wanted to send you that link as well. So I'm kind of giving you like, where to go next, and it's not that expensive, and get a bunch of more information on sampling. But what is sampling? We have sampling risk, and we know what 100% auditing is. What do we do now? We need to kind of set our audit objective, and then define for each one of those audit objectives what attribute we're testing. I mean, I believe you can test 5 attributes, in a sample. Like you could pick an item and test 10 things, with it. It's not something, once you've done something randomly, let's say, or statistically, it doesn't really matter. But we'll kind of talk about that. But just kind of seeing the difference there of the attribute is more of a control, or it's more of a value that you're testing. You need to set the population, which would be number of records if it's like process transactions, or its value if it's a monetary unit sample. Select the sampling method. We're going to talk about that. Calculate the sample size, audit, and evaluate. So I mean, I just want to kind of give you the broad brush of these are all the steps, and I believe if you go to the AICPA guidance, this is kind of what you're going to see there. As we continue further though into the types of sampling, and that's what we're going to talk about today. As I said, I'm going to show you how to do a random and a fixed interval sample in Excel, and we'll also then talk about a monetary unit sample, which is done in active data, and then a stratified sample that you could do by both. And the attribute sample, I mean, what you're kind of looking for in the random sample is deviations from expected controls that you expected to have in place. And the key thing that you have to do there is kind of set up an upper error, expected error, and margin of error. And I believe margin of error is like another way of saying it is confidence, in that. So these are things to consider. We'll talk much more about those as we continue. But this was an attempt in one table to kind of give you everything that we're talking about. And bear with me one second. I just did want to note this, that AuditrNet does have a monograph on audit sampling as well, which will talk to all of these input types. So, go out to AuditrNet and I'm sure type in sampling in the search engine and it'll get you to where you need to go. In the software input types, though, again, kind of delineating record and MUS. Now, why am I doing that? It's kind of in that first row there of the population. You either have a record sample, and that's for controls, or you have dollars in a field, and it's literally the dollars, and you're counting through those dollars in that particular field. So that would be something that that's kind of the difference in what is the population and what is then a unit. A unit would be a record, and then would be like 1 penny, I guess, in the dollars. From a confidence point of view, that's kind of how confident you are in the sample, and it's another way. I kind of feel like it's almost like what you're assessing. Your confidence. It's not sampling risk, is my understanding. It's more of your confidence in what you're doing here and what the process is doing. Now, another way of saying it, and way a lot of the statisticians say it, is beta risk, and that's the risk of assessing control risk too low or accepting a balance that's not correct, and that's kind of like you're 90% confident. That means beta risk is 10%. So that's kind of how 10% of assessing control risk too low, or the value. The upper error percentage, from what you expect in there would be, something that you would be able to kind of like handle as a limit, the upper error rate percentage, and then the expected total errors, from I'm sorry, and on the other side from a monitoring unit sample, that is materiality. From an error rate percentage versus error value, the expected total errors, so you can say, just showing the upper error and expected error, you could say, well, I believe, or we could accept a 10% upper error limit, meaning 10% of these transactions are not following the control, but we only expect like 1 or 2%. And then that would be something that you'd have to kind of set. Now, what I find with those 3 items, and we have a few others down below there that I'm not going to talk about, but the confidence upper error limit and expected total errors, those 3 are kind of the key in what we're looking at. A lot of times these are set for you. So I found whenever I was doing sampling that was something that was kind of told to me, as something that we're doing as a company. Now, there are ways, and we're going to kind of show you the differences in kind of setting different values here. But for the most part, I find that that's given to you. I find too, I mean, there's no reason why you can't kind of come up with your own, and that is something that we'll be doing. But before we do that, one of the first things we'll do here a little bit early in the program, but just to kind of stop for any questions, especially because this is very technical content. If you have any questions, feel free to post them. But what we're going to do is launch our first polling question for NASBA requirements. And what is the inverse of confidence? Is it beta risk, interval, upper error percentage, or deviation rate? So those are the 4 options, and we do this for NASBA compliance. You don't have to be right, but you do need to answer the question for us to kind of track that you were here today for the 2 hours. So we keep this open for about 1.5 minutes, maybe a little longer if there's questions, but do ask if you could kind of answer quickly, just for your own sake. I want to make sure you get the CPE. I don't see any questions yet. It's early. I expect more as we get into Excel, but I did want to kind of get through some of the stuff early on, and we'll leave the polling question open just for another 30 seconds, 40 seconds or so. And again, feel free to post questions if you have any. Okay, almost everyone's voted here, so I'm just going to give it like another, 10 seconds. and the majority are you know, I'm sure deviation rate's probably right, but beta risk is correct. I mean, that's what we were using it as, and what the statisticians will use. So let's continue on here. Okay. So going into the slides here, what I wanted to then do, now that we have some idea of sampling and some idea of the variables, it makes a lot more sense when you're looking at it in practice. So I wanted to kind of talk that through and going through these particular samples now. This is a picture of active data, and there are tables, especially like in the books that I've told you about in the links, that you can like manually calculate this stuff. But you know, or you know, feel free just to use these slides. You know, these aren't too bad. You know, from a you know, what you're looking at. It almost doesn't matter what the population is. Quite frankly, it's more of a percentages game. And you know, as we just talked about, you know, the three things you got to worry about, right, is tolerable error, risk of incorrect acceptance, and expected error rate. Again, incorrect acceptance beta, you know, is the 80%, 20% there. And then tolerable error is 10, and then expected error rate is 5. Now, what you're looking for is where you're exceeding 3 errors. Now, if you had a sample of 54 and you had more than 3 errors, you'd be in trouble. A lot of times, and just kind of, that's explaining sort of the mathematics here. What that's saying is if you pick up, you know, you could have 5,000 or quite frankly, I believe even 5 million. If you pick 54 and kind of work through these percentages, it is going to kind of work out the statistical means for you. And this is a little hard to see, but you know, I know when you print the slide out, it'll be viewable. But this is something where I went through various scenarios and just trying to show you how you can kind of change, you know, the difference between these you know, values and how that kind of changes sampling size. Now, the one that I'm kind of most used to, or at least I think we got it right, is you know, is taking a look at kind of that 30-unit sample. And you know, one way of getting there. There are lots of ways of getting there, by the way, but this is one way, where you know, you have an expected error rate of 2%, 15% is the upper error, and then you're 95% confident, you know, kind of thing. And that's where you have this resulting sample size of 30 with an expected error of 1. So you can't have, you know, more than 1. Or the beta risk there, which is 4.8029, would exceed the 5%. Now, if I change that a little bit to expected error rate of, I believe that was 5 up there and 15%, 5, you can see how the expected errors go up, number of errors go up, and therefore your, you know, quite frankly, expected number of errors in the, you know, in the what you can accept is a lot more. You could accept now 3 errors as opposed to 1 error, and then you know, down below, just to kind of go to a gross example, you know, where the expected error rate is 10%, you know, tolerable is 20, and you're 5% confident, and just to kind of give you an idea of how the expected errors change for each one. So we wanted to kind of give you that idea of how to kind of play with sample sizes, and I kind of have to show this to you in active data because it's sort of hard to do, you know, with all the books in front of you. But what you know, we then kind of can summarize and say these are other ways to kind of reduce sample sizes, and I'm not trying to play games here on that, but you know, what I kind of thought was you know, quite frankly, going back here, that maybe something like this is acceptable, you know, for some of the processes that you go through, where you know, basically, you know, for the inputs into that random sample, you know, you just kind of expect some errors. You know, you have a pretty high tolerable rate where it wouldn't, you know, crush the company if you know, this process didn't work more than 90%, and then you're like 80% confident. I mean, it kind of gets you to 54, you know, items, expected errors 3. I mean, there is a way of kind of looking at that size and feeling somewhat comfortable. But anyway, that's something to be played with, and but I did want to show you how those 3 work together, because that really is a key point in this. Okay, what I now wanted to do is kind of jump into Excel and show you how to do a random sample in Excel, as well as how to do it in active data, and then how to do a fixed interval sample in Excel. So let me just kind of quickly bring over Excel. Now, we will I believe state this a few times today, but you will get this link and the video file and the CPE, within about, I would say 3 to 5 days. I mean, I'm going to try to get it out pretty quickly. I know there's a lot of you coming today, so we do appreciate it. So we'll try to get it out to you. So this whole file that you're looking at is not something that you have to take pictures of and quickly kind of capture. You'll get it. You'll be able to play with it. And with that said, let me kind of start at the left here. We have payables data, and this is a data file that I use in lots of our webinars, quite frankly, and I do that on purpose so that we could all get comfortable with the same data. But with that said, to do a random sample, and I've kind of done a lot of YouTube and other sort of book research on this. There's actually a book out there called Excel for Auditors that Mr. Excel wrote where he goes through this. And okay, so the random number generator is the rand command. So if you just kind of put an equal rand into any cell, it'll calculate a random number. Now here's the problem, and I'm just going to go to formulas and go calculate now. Calculate now. I don't know if you can see that. Let me just kind of increase that a bit. But essentially, each time the values will change. So, this is kind of a crude way of doing it, but it works. And that is, okay, let's calculate now. And that calculates a random number for every item in the population. So I copy that formula, equal rand, all the way down. Okay. Then the next thing we do is probably the best thing to do is just take a copy of this and move it over to the right here and do this first. A lot of times they say sort it first and then do it, but I would even say take a copy of it, because notice as I take the copy, it automatically recalculated here. At this point, what you would then do is you can either go to Data Filter. It's an easy way to do it. And what all the good books say is to now sort in a high to low fashion, smallest to largest. You could do large to small, I suppose, but I believe the word, what I've been told is do small to large, and then you pick the top, 20, 30 items, if you will. So that's kind of the crude way to get a sample out of Excel, but it works. And everywhere I look for random sampling, that seems to be, kind of the way they do it. Now, I wanted to kind of show you active data and just kind of show you the sampling procedures in active data. Let me go over to the random sample. I think we had this from before, just to note this to you, but as I go to sampling, active data is an add-in to Excel. It's about $199 on a deep discount that we get through active data, which will send you the link at the end. You'll see it's in the slides later. And they have great sampling procedures, again, all pretty much downloaded almost from that book, the Sampling for Auditors book, and that was done purposely. I mean, just so that John's working with the most updated system, and John is John West with active data. Okay, so the random sample has a calculation button, so you can click calculate, and that goes to that calculating a sample that we were talking about before. So again, expected error, we could change this. I mean, maybe I'll make this 2%. I'm just kind of curious now. Tolerable error, let's even say 5%. And I'm 5% confident, or 95% confident, so I'm looking for a lot here. That's 181 items, what I mean? So it really is an interesting sample, but let's go with it, If I say to go to the sheet at that point, it'll kind of send that to the sample. But what I will do, and we'll show that to you in a second, that's this tab right here. But if all I do now is kind of line that up, now that I've set up what I have, the only item down here is the random seed, and we'll talk about that. That is something I'm pretty sure is randomly calculated every time you open up this screen. So let me prove that. I've never tested. Look at that. So yeah, it's a random seed. The random seed number is interesting in that if you change the seed number back to what it was when you pick the sample, you'll get the same sample. So just so you know, like that random seed has a value, but it's something that you can kind of generally leave as random. If you know what it is though, and it's from the past, you can enter something in and it'll pick that sample again. Okay, with that said, that's the random sample. If I hit finished, it then goes through and pulls out the 181 items. And I'm just curious, I believe, yeah, what it does way over here is it kind of sets up, what was the item and what was the original row. And I think you can even click on this and it brings you back to the original row. So if you wanted to go back to that actual data, you could double click on it. But that's beside the point. I guess you just wanted to show you how quickly it is to kind of calculate and have it pull the, I believe it, 181 unit sample. Okay. So with that noted, let me kind of continue onward here. The random sample size, this was from before. This was from the slide that I showed you before, where we had a sample size of 54, 5% expected error rate, tolerable beta risk, those kind of laid out. Again, this kind of giving you the results in more of the Excel format so that if you needed to kind of show it to somebody or put it in Word documentation or whatever, it's available. Then, bear with me 1 minute here. What I wanted to do is talk about a fixed interval sample. So random sampling is obviously random, where every item has the chance of being selected and you just randomly select it. Fixed interval, I believe, is similar. You could almost make that statement, but it's going to be done in more of a fixed interval approach. Now, you might have a starting point. I've started on row 2 here of the data, but maybe you have a starting point of row 20, of the data, and then it kind of continues from there. But what I wanted to show you here is this formula and how you can kind of do a fixed interval sampling, within this formula. So if you just kind of type this in, equal if, and then basically D2 being the item above is equal to 20, then make this 1, if not D2 plus D1. And just by having that, and then count, starting wherever you want to start, so you can, kind of move this thing around. But you then just copy that formula all the way down the data. And that sets up the interval. Now that you have that, and I'm going to put an X in this first one because I find, oh geez, sorry, can't do that. Maybe I could put a 0 here though. There we go. So just to kind of have a value here, I always find filters get a little funny if you don't have a value there. So we can go to Data Filter. And what you now can do is, I guess you could decide, but generally speaking, you would filter on all the 20s, because those are the ones that were picked. And, this is how in Excel, we're going to calculate a fixed interval sample, but this is, if you were doing a 20-unit sample, you would then be able to filter on the 20s. You would highlight all the data. A way to do that is Control-Shift and the number 8 key, the number 8, and then copy that data. And then I would move this, generally speaking, if I could hopefully do this way, yep, Insert, Worksheet. And I would just kind of make this more of a fixed sample by going to Paste Values. And then that would be my sample. Now, in this case, we have a sample of 242 items. And let me kind of give you, so we have 242 times 20. Oops. And I think there were like another record on top, so 4841. I don't know how far off I am, 4841 in the data. And then let me kind of clear that out. When we look down the number of records, I was a little bit off, but so it's 4822. It was pretty close, but it went down and kind of pulled this fixed interval, pulled all the 20s out, and then that provides that interval. If you want something that's less than 242 items, though, as opposed to that, what you could do is take a look at your number of records that are in the data. I believe it's 4821. And then what we'll do is we'll say, okay, we want to get to a sample of 30 in this case, and then you would just divide the 4821 divided by the 30, and then say it's 160. So okay, so it's 161. So then you'd go back into here and type in 161. And let me just get rid of my filter here. So this is the one with the 161 copied, and I'm going to copy that all the way down. And now I'm going to do fixed interval, 161. And let me go to here. And I typed that at the top really just to remind myself, like, which one is it, but you technically could just kind of scroll down to the bottom, pick the last one. And, I mean, hopefully if I got my math right here today, we could even copy and paste this, probably even over here, but I'll go over to the sheet 1, 2 again. Just go over here. Okay, and just kind of paste that there. And, you know, looking downward here, whoops. There we go, yep, 30 items. So, you know, basically we're able to kind of pull the sample we wanted. It's a fixed interval. And, you know, and this is the way to calculate it. So that provides you kind of that summary. And, you know, whether to use the random sample or the fixed interval sample at this point, I think it's a matter of preference. Again, I think it's a matter of whether or not, you know, the organization is going to kind of support it and, you know, go to the auditor and say we think this is a better method and this is why. But what I don't like so much about the fixed interval, even though I believe you can use it in the sampling size, I don't believe it's as statistical. You know, I mean, it seems like, you know, just by looking at you know, what we're doing in random sampling here, we do a random sample and then we hit you know, finished, and then that kind of calculates and you know, pulls that sample for us. But it's not so much at a fixed interval, you know, kind of setting. So just kind of noting that, and therefore, you know, I think the statistics apply more towards that than this fixed interval work. But I do know a lot of organizations like fixed interval. Kind of, you get a feeling that you're going through the whole population as opposed to only picking kind of randomly, where you could get, you know, items 2, 3, 4, 5, 6, and 7 in the sample, and you know, you kind of want to spread it out to the other items. Okay, let me just quickly kind of get back to our slides here. So we kind of talked through the fixed interval sampling. I kind of had the slide in there. The key here is that formula, and really just changing the 20 there to 161 or to 50 or, you know, whatever you want, but it'll then kind of create that particular sample for you. So, you know, with all that said, let me kind of quickly go to our next polling question. And I don't see any questions yet, but feel free to post them. So finish the sentence. For fixed interval, the key Excel function used is it VLOOKUP, percentile, HLOOKUP, or if? Again, we'll keep this open for questions, keep it open for about a minute and a half, so if you just didn't have the time to kind of click on it, but hopefully we can get through this quickly and kind of continue on. Have a lot to talk about still, which is good, and but do look forward to questions as well. We have a lot more different sampling techniques to show. You know, so it might even be good towards the latter part of the session that we kind of talk through or even debate a little bit in the questions, like which one's better, or, you know, what makes sense. But it is kind of hard to do, you know, on the call today. So again, feel free to post any questions you have. Thank you. Okay, I'll keep that open just for another 10 seconds. Most of you voted, over 90% have voted, so thank you. Okay, so let me close that poll and share that with everyone. The if statement is correct. Probably you could use VLOOKUP at some point, but the if statement is correct, and what we were using in that previous slide. Okay, let me just hide that poll. And we should be back. Great. Okay, so monetary unit sampling
It's otherwise known as PPS or DUS. I should have put that in there. Dollar unit sampling is another one for it. Dollar unit sampling, though, it's so Americanized, so I'm not sure if that's the right term. But I do like monetary unit sampling. It tends to be what most people call it by MUS, or monetary unit sampling. So continuing on with the names in mind, it kind of uses all of the same principles. It translates things so that the unit of record is not a record, but rather a penny or a dollar. I guess in this case is what we're saying, a dollar. It generally don't have sampling intervals that are pennies. It's more of a dollar and pennies that are added together. But each dollar has an equal chance of selection. However, if you're $1 million, you will have more of a chance of selection than a $1. And I believe it's 1,000,000 more percent, of a difference. So it is something where, the monetary unit sample is something where it's more weighted towards larger values. Monetary unit sampling is generally used where you're worried about overstatement and you're kind of testing the balance to prove, is it a true balance. With liabilities, I guess you could do that, like you could actually confirm that that's the balance, but in a lot of ways, I think a lot of times you end up finding, that they owe less, usually in that particular case, which may play to it, but I think with liabilities, you're more worried about the completeness of it and, what other payments were made that were not recorded. With assets, though, what generally is, monetary unit sampled, they are balances that you're testing. So it's like inventory, or a big one was accounts receivable. Now, I'm a big believer with accounts receivable of getting the cash from the bank and matching that back to the actual data, but I would say, 10% of people do that. I think most are kind of working off of the monetary unit sample to kind of prove statistically that balance is valid. And that's really where we're at here. It's more of a financial statement audit tool. There's materiality, which is generally set by your auditors external, but can be something that you come up with internally. And it is more of a varying degree of exception. It's not like a binary yes or no. It's more of a, it's off, we think, by about $750,000, kind of thing. But materiality is $1 million, so we don't care. It's sort of, we think it might be 750 off, but $1 million's materiality, so let's move on. And I think that's kind of how it, overall how it operates. I always feel you should expect some deviations. That kind of counts for both the random sample and the monetary unit sample, only because you don't want to kind of get into that stop-and-go auditing where, it's almost like you expect no errors and you do 30, and then if you do get one error, then that becomes like you have to do 60. That's a lot of people call it stop and go. I don't even really put it on the board because I feel it's much more of a judgmental, it is a technique, but it's something where it's very judgmental, but it is based on these statistics, that we were showing before. The most likely error is a tainting percentage. We'll talk about that times the interval. I think some of these mathematics, again, I think you're better off using more of an active data to do it as opposed to, getting the books out. As I said, that New York State Society has a great article out there, and it goes through the entire set of techniques that you would have in doing a sample in Excel. But again, it seems to even use a couple of tables at least in what they were showing in the article, and I just felt for today it was going to be a little too hard to go through that. But again, I've kind of explained the theory to you. I feel a lot of people even use products like ACL or Excel, and Arbutus is another, IDEA is another, and all of them will do monetary unit sampling and record sampling and all that stuff. Okay, so and just a couple of questions. I may as well kind of get to them. So You know, I wish I could get into Top Cats, you know, in this today. I don't have it loaded because it basically expired on me, and I don't have it loaded. I do know the techniques, though, used are you know, the similar, if not same. I mean, I find Top Cats and Active Data are very similar in kind of technique and how they handle things, especially. Oh, gosh, and PPS, so one other question was, what does PPS stand for? And I had that before. And I think it's like proportional something sampling, and I apologize, but it's more of like proportional to that value as opposed to, so it's more weighted as opposed to just kind of random, you know, just going all over the place. So
Rich?
Yes.
PPS is probability proportional to size sampling.
To size, thank you, thank you. See, if I had my CIA, I would have that knowledge.
And I also posted a link for everybody to the sampling resources that are available on AuditrNet. There's a guide from the UK. There's a guide from the Texas State Auditor's Office. There's also a guide from the Comptroller of the Currency. So,
wow,
some additional resources.
Thanks, Jim. And I find, again, I'm talking to two city governments right now, and both of them tend to have their own technique. Like it's something where it's been passed down from generation to generation, and this is how we do it. But it is good to have the tool kind of pick the sample for you once you know your percentages. And again, don't want to beat up the percentages too much more, but for monetary unit sampling, unfortunately, they have a little bit of a different angle. So the first thing is when we run this in Active Data, it's going to calculate the population value. So it's not number of records, but rather dollar value or whatever value. Then it's going to figure out the tolerable misstatement, which is materiality. So that's gosh, I believe that's another way of saying it, is the upper error limit, you know, in your percentage of control risk. But then you have your expected misstatement, which I think I even put in there as $100,000. So I have like 1 million and then 100,000, and then I'm 90% confident that that's true. So 90% confident. With all that, it calculates the rest. You don't have to do that stuff, and it calculates a sampling dollar interval of 367,965. Which is an approximate sample size of 11. So it's going to pick 11 items in there. Now, the basic precision, and I'm terrible at calculating this particular stuff, but again, it calculates itself. In what we're trying to avoid here is where, when we evaluate this monetary unit sample in a minute or two, when we evaluate it, that it doesn't kind of exceed that materiality, the tolerable misstatement. And we already have like a handicap, basically, a basic precision handicap of 850,000. So it's sort of lopped against us. And that's based on the percentages. You know, that's based on like what I expect and, you know, what I put in there as materiality and all that. It kind of calculates this. But again, just giving you an idea, now our goal is to pick the sample of 11 and have so few misstatements, like differences, that you don't exceed the $1 million. So this is the result in Active Data, and it's a little confusing. I even emailed John, you know, just to prove it out to myself. But what was really cool, and I can't give away the book, but I'm just noting, there's even like a page in the book that we were referencing before on sampling and sampling for internal auditors, where it's basically like pages 5, 6, and 7. So, you know, in looking just very quickly here at this book with John, yep, so this is, bear with me. Nope, I was already there, sorry. So yeah, what it does, without really going through it, it kind of literally calculates at this level and then even kind of follows all of what is in here in 5, 6, and 7, and then it kind of calculates at the bottom here. Let me just kind of scroll into that so you can kind of see this final kind of projection of the upper limit of misstatement, which they have at 48,000, and I think their materiality was 50. You know, so they were like, we're good. You know, we can accept the sample. So there are a lot of numbers here. I wanted to show you it came from a good place, and you know, then here it's actually showing and I did confirm this with John, is that my materiality was 1 million, and I actually exceeded materiality. You know, so it's like I go over by a little bit, and maybe you debate at this point if that's too much for you to worry about. But in essence, I kind of blew my sample, and let's kind of look at this evaluation now. So we looked at it from the sizing point of view. Now we're kind of looking at it from the closing part or the evaluation point of view. And in here, what you'll see is that you start out with a book value of the 119.75, 857, 2657. These are essentially the value that you had in the report or the data file. Then when you audited it, you then had the audited value, and then that kind of led to this difference of like $30, $10. And it's amazing how these little differences, you know, throw you over, unfortunately over. But it's enough, and that's, again, it's not by much, but it's something that does kind of exceed. So I wanted to, let's go into active data. I wanted to kind of give you the theory and kind of walk you through the sort of overall aspect of it. And let me just bear with me as I clean up here just a little bit from our fixed interval session there. Okay, so let me just reorganize just a little bit here. Sorry about this. Okay, so I was just showing you before, oh, no, I didn't even show you this. This is where we did the calculation of what is the particular interval. When you export that to Excel via active data, so we just kind of said, like, you know, finished or something, it then sends it to this worksheet, and you're able to kind of have all the results. We're kind of, gosh, you know, it has a lot of percentages here, but I will, and it kind of has an increasing value, but what my feeling is just sort of use the evaluation tool. It's a little too complicated to do this math manually, at least, you know, in our session today. In my case, what I was trying to get to is a sample size of 10, basics precision, but let me kind of go over to the data now. So I wanted to show you that this was the evaluation we just talked about, but let's go back to the data. So in active data, if I click on sample, we have monetary unit, and we have the sample, and we have the evaluation. So it's two different things, just so you know. The column to sample, we will pick the invoice amount, and I'm going to go into the calculation just so we can play with this a little bit. Okay, tolerable misstatement, $1 million on a $4 million balance. So $1 million, I assume, is sort of in general terms of you know, not for the whole company, but I guess of each individual item that can happen within a process flow. The expected misstatement, maybe I should, you know, I have it at 50,000. This at 10%. I mean, these are pretty good numbers, I suppose, if I was picking any. And then we calculate that. So that kind of gives us this interval of the 400, 443, 10 items, and basic precision of 925 to our million. So we have a lot less room, and I think it's because we were actually picking we had a larger expected misstatement, and the beta risk was different. Again, I can hit this to a sheet just by saying to sheet, and I believe that gave us exactly, you know, whoops, what was there. Let me click finished, and then, so now that I have that calculated, this is a little interesting. You have fixed interval and cell selection, and I'm going to show you the difference of that. But what monetary unit sampling is going to do at this point is it's going to do a fixed interval of the dollars, starting at the random seed dollar of 42,449. And it's going to go for 400,433, and it's going to do that fixed interval, just like we did before. There might even be a way to utilize, you know, that code that we had a minute ago that we were using for random generation for something like this, but I'm just not going to go there right now. I just think it's something we probably shouldn't attempt. Okay, with that said, you just hit your finish button. Now, even though it should pick 10 items, and it does, it doesn't have to. There are, you know, statistical
ways that that happen where it in essence doesn't get picked. What I kind of like is it gives you all this information over here. Also kind of gives you the original rows and things of that nature, and then obviously the original data after all that. But it gives you all the statistics, which I think is kind of cool. And then you would go off and audit the sample and look have your book value and your audited value. Now, just going back, actually this is a great place to do this, and I had done an evaluation before, but so what we have right now, and let me make sure I'm not picking the wrong one here. I'm going to look at these two columns, and what we're going to do is we're going to just let me just make them a little nicer to look at and a little bigger so you can see it. Okay, so what I'm going to do is I'm just going to change the audited value for a couple of these, and let me lower it. Let me make it like $45 for this one instead of $55. And for this one, you know what, I'll make it $218.22. And then this last one, I'll make it, so I mean, we already have 3 errors. That's a little too much. Let me just have 2 errors, because let's be kind of realistic here. Okay, now that I've done that, I can go back to active data. I can go into, bear with me 1 second here, into my sampling. I can select my sample here, and I guess I need to pick the right field. So invoice amount and invoice amount audited are the right fields. Hit finished, and then it calculates this for me. Now, oh, and I guess I only had one difference. I may have goofed, or one difference that was an understatement, because I think we're more focused on understatements than overstatements. And I may have even gotten like some benefit on the overstatement for this. But with that said, it does calculate and kind of shows, hey, we're under kind of that sampling interval. I also had that other evaluation, and apologize. This is how we know that is we're essentially 925 is less than 1 million, as we talked about before. Again, this was another evaluation where I kind of blew the sample, and this gives you an idea of kind of the projected misstatement for each one. On this one, what's kind of interesting is I ran it on the entire data set, but I don't think it really, it doesn't matter. If you can run it on the sample or you run it on the total data set, it's still going to kind of come up with the same answers. Okay, so with monetary unit sampling, I wanted to show you one last thing. Whoops. Let me just go back here to the original data here. When I send you the data file, by the way, it'll be reset, kind of reordered back to where we were when we started, so that'll be a little easier for you. One thing to consider, and it's just an idea, is that there is fixed interval where you're going to kind of go through, and count 161 items. And let me make this a little bit easier, just for right now, and just kind of make it 20, or even 10 would be good, and copy that all the way down. And the difference, one thing that we had before in active data, and I just wanted to show you this, that in the monetary unit sampling there's this cell and fixed interval selection. What you could do in this particular case is do a cell selection, and what that'll do is I think for the monetary unit sampling, the way it kind of works in a record sampling way is it'll look at this first kind of fixed interval, and then it'll pick a random sample within here. So that is another approach. Like you could use monetary unit sampling cell, and then I believe it'll kind of look within the cell and then random sample within there. So it's like a tricky addition to the concept of sampling, where it's sort of in between a fixed interval and a random sample. It's like a combination of the two. Okay. And hopefully, I don't know, from a sound check point of view too, I've gotten just 2 people coming in saying, the sound may be losing quality, but it looks good to me, so hopefully it's okay for everyone so far. I'm just kind of noting the questions as we go through them. And what we will do soon is we'll get on to the stratification, but with that, let me just wanted to make sure we've gone through everything for
our evaluation. And just to kind of conclude on one thought, because I still feel like it's a very, it's something I kind of go around myself over and over on a bit, is just kind of going back to this and kind of looking at, our confidence again, with the beta risk being the reverse of that. A lot of times with the financial statement work, it is kind of noted as we're 90% confident that our upper error limit will not exceed materiality, so you can kind of see how that is stated. But we do have kind of an expected tainting or error percentage of 2% or whatever, and that's like $50,000. So there's a way of kind of noting that. What active data does, instead of a maximum tainting percentage, it's actually, or the expected, the expected total errors, there's an error value, and that's what you're entering in there. Apologize. The tolerable errors are down below, where you ultimately kind of figure out what is tolerable, and then ultimately, though, you really need to see, is your upper error limit exceeding now your materiality? And that was based on that evaluation. Okay, so we're kind of at our next polling question here. So let me, that is, so bear with me 1 minute here. And that polling question is not what's on, wasn't that slide for a second. It was basically, what is not another name for monetary unit sampling? Is it MUS, PPS, fixed interval, or portioned? So what is not another name for monetary unit sampling? MUS, PPS, fixed interval, or portioned? And from a question point of view, I do know there's a couple of audio notes, but I'm kind of seeing myself with a really good sound quality, but it may be dipping somewhere. It may also be internet connection, and that I do know that happens at times as well. See most of you filling this out. So we're over 90%, so thank you for that. So one of the questions coming in is how to get the active data toolkit, and basically I will open that up when we come back from break. I'll kind of show you the link and how to get there and such. So yes, thank you for that. We'll show you that. What's nice is, there is a 30-day license, but I'm pretty sure you could extend that pretty heavily right now. So if you needed a little more time to kind of utilize the product, and that's what most people are doing. They tend to kind of get started with the product through a sample audit or such, and then kind of go from there. All right. Well, let me kind of close this poll. Share that with everybody. And yeah, fixed interval, I think the last two were kind of trick ones in a way. Portioned, I came up with some word, but it isn't. That was the one that I was thinking of. Monetary unit sample is a fixed interval. It is kind of fixed interval going through the dollar unit, the dollars to kind of get to whatever unit it's selecting. So it did have that aspect to it. But anyway, with that said, let me hide that. Thank you for your responses. And let me get to a couple of your questions here. So one of them is we're going to show later in the slides where there's a link to active data. I've kind of put that link in here, and I hit enter. So, and I may have just, bear with me, sorry about that. And I just closed my, there we go. So this is the active data special pricing. I believe it's $200. It's a pretty big discount to what it is. I think normally the product is like $349. There are some CP books and things like that too that also are at like a 20% level off as well. And And what you can do is kind of download it from Active Data or Information Active. You can play with it for 30 days, and then you can kind of, decide which way you want to go. Another kind of question had come in, please provide some real-life audit objectives where you use different sampling techniques. And, the first one would be for a financial statement audit, what you would be, let me kind of go back to the slide because I think we have this summarized here. Here we go. So in taking a look at this slide here, I think on the random or attribute type sampling, you would be looking more at like testing controls. So you would be testing, say, that particular receipts have travel and entertainment, business objectives, and other supporting documentation for that receipt, and that it was approved by manager, and each one of these becomes like a control that you can test as an attribute. From a monetary unit perspective, you're looking more at a value that you're then testing, and therefore inventory value, accounts receivable value, cash, and it's usually an asset. It's not a liability because you're more worried about overstatement at that point. As I get into this last section, and this may be a good point of that question, is it gets into more of a stratified approach. And I talked about the first two being more statistical. They should work, should find what you want. But when you're picking like 10 items out of 10,000 or 100,000, I always wonder, it always makes me think, like, how does the statistics add up? And that's kind of where the stratified comes in, where in essence you could stratify by amount, by the score of that. We're going to talk about setting a score for each transaction based on how risky it is. So that could be another idea, or just statistically, like how big is that value, or other factors such as that certain amount that's showing up, like $15.22. How many times does that show up, and is that reasonable? And and all that stuff can be kind of statistically analyzed. I find that the stratified sampling is where you tend to find more stuff, like you tend to kind of learn more, and hence let me kind of get more now to the stratified samplings. Bear with me here. So with stratified sampling, what you're doing is you're kind of breaking up the population into buckets or strata. The strata could be value, it could also be stratification on risk. So if you find that a certain process has more risk to it, you might have more of a sampling approach that has a higher rating than you do to something that is of a low risk. So again, maybe P-card transactions, you would risk a lot higher than general invoice entry transactions that are matched to POs. Like those would be a lot lower of a risk. Then what I find is that you have a much better potential to identify issues because you're focusing on those areas of the business, of the process, that have a much higher error rate calculation, or have a much greater chance of being a value that doesn't calculate or what have you. These are not statistical. This is much more of almost like blending the exception reporting, where we test 100%, which I still think you should consider, to blending that with random sampling, where you're kind of now thinking about the sample and using more of kind of like your auditor judgment. But again, and within each one of these, by the way, you can then pick a random sample. So it's something where again, the random sample that you're picking for the P-card type will be completely different than what you do for the PO and invoice type. That would be a way of kind of stratifying it. A lot of people, though, when you say stratified sampling, it's on value. It's more what is over materiality, because we need to kind of pick all those items. Anything that's over materiality generally is they'll kind of pick, from a testing point of view, from like a dollars perspective, and then you would kind of sample other strata below that as well. Okay, so continuing on here, this was, we're going to show some graphs, but I thought this was like a great way of kind of showing how you could kind of stratify basically who is entering the journal entry and the time frame. So it's basically who is kind of working, backwards, so in more of a three-dimensional way, and then the time is more on the two-dimensional line. And with that, you're able to kind of see very quickly, who might be sort of a larger, contributor. And really from a stratification point of view, you might even want to do something like this, where you're not even looking at total value, but looking at months where a certain enterer had a lot of activity. So it's now kind of like not only that the enterer had a lot, but that it's within a certain time frame. For example, like the person in yellow in that particular chart, they have obviously a very large balance, probably the largest balance, of everyone when you look at it. But I wonder, sometimes like if they have a lot of small balances and then like one large balance, they may be under a lot of the on anyone's viewpoint, so that if they're not selected, but yet that would be something that you'd want to take a look at. So I wanted to kind of give you a visual on stratification as well before kind of diving into the Excel of it. Now, in Excel, there are two different ways that I stratify data, and then I use active data, and I wanted to show you kind of all methods so that you have that. Okay, first one is way more complex. We're going to show it to you, but I kind of question if you want to spend a lot of time with it. This is where you're kind of calculating an if statement, and in the if statement you have various sort of like almost like if and kind of statements that are built in there. It's a lot to write, in my opinion. The second way of doing it is using a VLOOKUP, and in this case we're using the true as opposed to false statement. And what that does is it allows you to quickly identify anything that is under a limit. So again, let me kind of quickly show you this, but you have this. The last version is where we do it in active data, and it kind of does it for you at this point. But I do want to show you that you still can do it yourself. So it's not something like you have to go to active data to do that one. So okay, let me, with all that said, let me kind of get into Excel because it's a lot nicer to look at. So I'm going back to the original data set, and that's all the way to the left, where we have all the data. And let me just kind of scroll to the top there so you can see it. Over on the right-hand side, I deleted that format. So let me just do one thing here quickly. Let me not save that. Kind of open that up again. In our playing around, we deleted the item, but let me see if I can get that back. Yep, there we go. So this particular strata is calculated based on this VLOOKUP over here. This was the original strata with the if statement. I'm not going to waste our time with it. I just feel like it's not worth our time. But this VLOOKUP is. What you tend to do, I mean, you could put I put like a minus 50,000 and then a 0, but you don't have to. But I just feel like I have to have 0 in there. And then I have up to $100 with the 0.01, and then we have over $100 to 1,000, etc. So what the VLOOKUP does is it kind of works in more of a way of looking above a certain item. So it's something where if the VLOOKUP finds an item and it's $101, it's now over the 100, and it kind of goes into the over 101 to 1,000. If the VLOOKUP finds that the value is closer to 20,000, it's going to be over 1,000 because that's the final limit that we set in here. So that has been calculated into this VLOOKUP. I'll just kind of look at this, show you this VLOOKUP quickly here if I can. Yep, cool. So this gives you an idea. We're looking up the amount value, which is way over to the left here. So we're looking up this amount value over here. We're looking in the table array, which is over here. We're looking for column index 2, and then we're using true as opposed to false, and that kind of calculates that. Now that I have that, I can insert a pivot table. Should work. And it goes up to S, which is good. That's kind of all the data that I want to grab. Hit OK. So now I have a pivot table. Just bring that over here. And then what you can do is you can click on that strata version 2.
And you can also kind of bring the invoice amount into the values section down below here. Drop that, and that'll sum it. And then you can also bring it down here again if you want to. And you can change the value settings, value field settings. You can change that to be a count versus a value. So this kind of gives you now the stratification and each pivot table. So this is the strata pivot. Now you could get fancy, if you wanted to. I might look at it from a count point of view, but let me not get fancy yet. Let me kind of stick to this one. What I would do is I would double-click, let's say, on over 1,000, because let's say that that's something that's pertinent to me. And you would double-click on the 794, and that'll create a new tab that has the 794 transactions in it that are all over $1,000. So that's, as you can see from this invoice amount over here. What you now could do, or should do, is pick a random sample within each one of these strata. So you could do a fixed interval, a random, but this would be kind of now, this is population 1. Pick your sample. So let's say this is over 1,000 sample. And then you would go back, to the strata pivot and pick the 100 to 1,000 and say, okay, this is another, thousands of items, and we would pick another random sample from here. And as you pick each one, you would then have to copy and paste or filter, like you could right-click here, insert, and just kind of randomly select, or, again, use some of the techniques we talked before. And when you're done, have kind of like a field appear called selected. That you could then select those items and say, we're going to pick 3 from the over 1,000, for example. And then you could highlight all this data and kind of copy and paste it into a new schedule or sheet, and you would have to do that for each one of these strata. So that's kind of how that works. Like you would build your strata, you would then summarize on that strata or filter. I mean, another way of doing it, quite frankly, is not even using the pivot. Going back to the payables data and just filtering here, and just copying and pasting out of this. But, that's the way to do it. I've seen some people even just kind of do it within the Excel document itself. So, as you go through each filter, just giving you some ideas here, you could pick over 1,000, do whatever selections you're making. Don't mind the random number that keeps recalculating, and then go to the next strata and do kind of the same thing. That's generally how I'll do things. Is, I'm thinking of like duplicate payment testing and stuff like that we do. I'm constantly doing it this way. Okay, so going back now that we kind of know how to select items, in looking at it, what do here, I'll just try to blow up the screen a little bit so you can see it if that helps a little bit more. Continuing on here though, in the strata pivot section, what I wanted to show you was an easy way to kind of maybe get a little bit more perspective. Now that I have the count here kind of listed out, what we could do, if I can quickly find it, is try to identify like a year field. Well, maybe we'll even do day of week, and say that day of week is kind of a risk. Day of week is something that I calculate in the payables data as using the DO, well, I think it's the weekday function actually, but let me take a look at that. Yep, it's the weekday function. So what you can do here is kind of select that item, and then in this particular strata here, what you can then do is start to kind of look at, do I want to sample things on a Saturday, which is what these are, versus a Friday even. Maybe Friday is a better day where people make mistakes, or, again, a Monday or Tuesday or something. But that's another way of looking at it. Obviously what's really weird is why they have so much on a Saturday. Actually, no, wait, that's a Friday. Sorry. 1 and 7 are basically 1 is Sunday and 7 is Saturday, 6 is a Friday. So this could be a way of looking at it. But what you want to look is kind of for that trending. And when I look at this data, a way of kind of trending it quickly is to pivot chart it and just hit that. I even like to use this 3-dimensional column approach and hit OK. And that kind of gives you, again, a different perspective, where you kind of look at the Monday in the up to 100 and say, wow, that is a really interesting trend that it's like double of anything else, that we're seeing here. So anyway, these are just ways of kind of stratifying your data and possibly thinking of it, not only by amount, but by day of week might be one approach. Another, notice how the graph changes, by the way. Another is by enterer, so you might want to drag enterer in there and kind of look at it from that perspective. I guess, the problem with stratification is at some point you kind of have to pick an angle, right? You can't have 20 different angles that you're kind of working on. So you'll need to kind of, decide if it's going to be based on enterer or day of week or month of year or, whatever you've selected for that particular item. Okay. Let me kind of continue on here. I think we had one other. I just wanted to show you potentially one other chart here. I kind of had that stratify again here, just to show you here. One of the functions that I really like within Excel, and it's something where I may not be giving it the most value display right now, but in looking at this count field, you can see kind of the percentages here based on invoice date. The way I got there is, I believe you go down to the count field down below and go to value field settings. I am counting it, but I go show values as, and you say percentage of column total. I guess you could even do percentage of grand total, and that obviously gives you a much different perspective in that now you're looking at things and saying, wow, 2010 was a big year for us. Like that's where all the data is, right? And et cetera. But I mean, it's something where sometimes the numbers, you have trouble kind of seeing it. By looking at it in percentages, now you see 87% is in 2010, and maybe we should put more focus on that year versus other years in the data because we seem to have a lot that's in that particular year. Let me continue here. This was a very complex way of looking at people and year, which again, this is what we were looking at before. It's using the same data that I've shown you, but one really kind of cool thing. I think this is like, it's like $231,000 of a negative item, but it's kind of cool how it does show up very quickly, and something that you can maybe sample individually because you just decide that that's a month that we really should be looking at with such a huge disparity there. Generally though, these items, and this is what's kind of neat about maybe stratified sampling and how I've talked about how you can kind of meld exception reporting with sampling a bit, is if you can go to that month and year, so I'm just looking here, it was KD for 2011. So let me kind of go KD 2011. Let me just do my best here to try to get this for you, sorry. So for the count, and I believe there was a month in there. So it must be the month of July, May. So I just kind of missed that. But anyway, a little hard to look up, but you go back in, you select that item here. These are 80 items. I could then, maybe sort these from low to high and see, wow, that's really weird. We generally don't have large credits like this, but, in that given month, for that given enterer, we had very, very large credits showing up that added up to, 300,000+. That when you added up the entire month for that person, it ended up being like a negative value for $231,000. So, again, I think even just, melding all these different types together does allow you to very quickly, pull a much better stratified sample. Now, I think this might be a good time. What we'll do here is let me kind of get to this polling question, and what we'd like to do is just take a quick I'll say 3 to 5 minute break, or I guess we'll say 5-minute break, that will go to 12:25. Jim, let me know if that's too long, but I think that would we'll have the polling question. Any questions?
That should be fine, Rich.
Yeah. Okay. Sorry, I'm just seeing your note there now, but I agree. We should take a break. If you do want to answer this quick question, though, before you leave, that would be best. What is the key Excel tool needed if we calculate a summary stratification manually? So what did we have to to get that summary of the stratification? What was the key tool? Tables and reporting, charts and graphs, pivot tables, data analysis add-in. And what I will do, I mean, you won't see it on the screen. I think I'll leave this polling question up for now. Hopefully that won't be confusing to folks. But what we'll do is we'll just kind of take a quick break till 12:25. And if you wanted to come back, please come back maybe just a little bit earlier because sometimes clocks are a little bit different. But again, per my computer clock, I have 12:20, so we'll take a 5-minute break. For those that are still there, as I said, I'll keep the polling question open for that amount of time, and we'll also we'll kind of if you have any questions in the interim that you want to kind of edit in now, this would be a great time to edit those in as well. So thank you, and we'll be back in just a few minutes. Okay, well, I'm just coming back. It's about 12:24, and I see that the polling question's actually been open for about 5 minutes, so I think we're getting on to the 5-minute mark. I'll just give it another 30 seconds or so just for those folks coming back, and then we'll get back into it. One question that came up, I did answer it, but I'll just note, was on standard deviation. And when are we going to use that? And it's great timing because we'll be using it in another 10 minutes or so, and I'll show you what I mean. And I learned a lot on that part of it, actually, of how to use Excel and many of the functions that are in Excel that I didn't realize are very valuable. Great, and I do see some people that had to leave for a fire drill. No problem. Well, no problem there. We got you covered on that. Okay, so I'm going to close and share that. You're correct, or most of you correct. Pivot tables is the answer, and that is for that particular summarization on stratification. And let us go into scoring now. So, I kind of alluded to it a few times. I don't want to spend a lot of time on it because it's more for kind of like another presentation in a way to itself. But there is a way of kind of calculating the score for a transaction based on, how many reports that it's showing up on or how bad it looks. And this was some attempt a while back. I had a statistician friend of mine kind of, give me this. What we were noticing, and think about this for a second, was that if we had transactions, so if we had 5,000 transactions, we found about 1,000 of those transactions would show up on some report. Like it would be either a round dollar report, a weekend report, a duplicate report, you name it, it showed up on at least like one. Therefore, it kind of had this red flag to it. But what we really found was that out of those 1,000, out of 5,000, the percentage of actual problem, in this case it was a duplicate payment, so like a recoverable overpayment, was only like 0.03%. So even if you pick these items that look kind of weird for, say, duplicate payments in this case, it didn't, it was very, very low percentages. So you had like a 1 in 800 chance of a red flag leading to a problem, and that was kind of the calculation there. I'm going to trust in his math skills better than mine, but I liked it. I liked the concept of, imagine throwing a random dart at 800 balloons hoping to hit the right one. I think that kind of gets to, the sampling problem in general, and how kind of scoring and standard deviation, which I want to talk about, can kind of play into that. So scoring is something where you're defining a bunch of reports, let's say 20, 30 reports, that you think that if people show up on these reports,
there's something weird about them. You know, it's nothing terrible, but it's for example, if I have an item that is $15.12, I think we used this before, that is showing up 500 times in my data, that's weird, you know, that I have that, and therefore that shows up on like a weird amount showing up a lot report. So that's just one report, but it doesn't mean anything. Then if it's round, it shows up on another, and if it's on a weekend, it shows up on another. And then you start adding these up to a point where, you know, you're picking a sample where the items are the most severe. So instead of picking things rare in like one way, you're picking it rare in multiple ways, but by doing so, you're able to kind of, I think, get a better read on actually hitting something. Now, you know, what I found interesting with the duplicate payments, I'm just going to go back to this, like a client of mine, when we filtered on all of these duplicate payment flags that we had, and flags, like an example would be, was it paid on a different check number? So, you know, if it was a duplicate payment but it was paid on the same check, that's weird. You know, that's normal in a way, like they probably knew what they were doing, but when it was paid on a different check, it had a higher chance of duplication, so therefore we noted it. And we did that for a lot of things. And when we were done, 50% of all the items on that sample, the sample is very small, but 50% of the items were duplicated. So, you know, again, out of hundreds of thousands of transactions, we picked about 50, but about 25 of those were duplicate payments. Now, to do that in a sampling approach would never happen. So I don't think, you know, it would be so improbable. But you know, in our case, when we're really looking like for actual results, like we're looking for money, this is kind of how you're going to sample. It's not even sampling as much anymore as it's really like scoring and working off that score. So, you know, transactional scoring is really a sampling methodology which is based on the risk as you define it. So what reports are risky to you, what indicators are risky to you, let's kind of score now on that. So I'm going to show this to you in Excel, basically the VLOOKUP of those things. And ultimately what we're trying to do is kind of getting to a single score for each transaction. So let me kind of get into the data here for just a second here. There are two other schedules that I'll be sending you, again, within about 3 to 5 days. And one of them is this report here that I first want to talk through. And there's another one that has some graphs, but I'm not even sure you even need that one, but we'll send it to you as well. This one, though, what I was trying to get at here was showing how VLOOKUP, and VLOOKUP being shown in the top here section, VLOOKUP can be used to join together these 7 reports. So what I did was I ran 7 reports, and I'm linking them all together currently using this VLOOKUP. Now, in each one of these reports, we then have, let me just kind of go over, I don't believe you can kind of see this right now, but on the left-hand side here, you can see that's the supplier number. So I'm just noting, is that supplier number, let's say 5, showing up on report 1? Well, let me go over to sheet 1. Supplier number 5, yes, does have a score for that report, and hence it showed up on that report. And that's really what we did here. We just kind of joined together all the report files into this one file. So, you know, does it show up on the report or not? You could use 0.1, you could use 1. There's a lot of different, you know, approaches here to kind of getting to a final score. I'm pretty sure the way I approached it was 100%. So I kind of made all the 7 scores when you added them up. Each one was a little different. By the way, I weighted the scores. So report 5 was better than report 2 by, you know, 100% better, essentially, but by being 20%, and this one's 50% better. So, I mean, there is a kind of way of weighting this together, and then ultimately kind of looking at those transactions in a weighted fashion. As we said before with stratification, though, this is a perfect way to stratify data. You know, I don't have this set up for you right now, but it's something where you would basically kind of do a stratification on this final score. So let me kind of show this to you in active data, just quickly here, but also kind of getting that stratified sample out. So what we want to do, instead of picking the sample button, is we're actually going to pick the stratify button. And in my strata, I'm actually going to stratify on the final score.
So that'll, and it kind of calculates a max and an average and a min and all that stuff. And then just kind of quickly here, I'll put in strata 1, which is, let's say, 0.1%, and then I'll make it to 0.3% and 0.5%, and let's just do over 5% because I don't think there were any. Okay, well, most of them are showing up in there, so that's not too fun. But let me kind of insert a row in here now that we have that, and we can make this 0.2. Let me, whoops, sorry. Let me try to get up to a 0.2 here. And then I can re-stratify now that I've added a row, and I'm still not picking up anything. So let me insert a row down here as well. Or I think actually, you know what? I think there's a way of creating some bands as well. Or actually, you know what? This final score. Sorry about this, folks. I did want to show you the sampling approach, though. So that is 45%. Well, anyway, let me, I think I have too many items that are within like 35 and 45%, so let me just quickly try this one more time. We'll go from 30 to 0.33, 0.33 to 0.35. And let me try this one. All right, so we're getting just a couple of strata, but one is where we have it between 35 and 38, and then we have items that are over 40. And you could kind of see that down here. And I just want to show this to you quickly. What you can then do from a stratification point of view, you have a lot of options. I mean, you could stratify by group here, which is kind of getting into, down to but I'm going to just say, whoops. Okay, just making sure everyone still hears me. Okay, good. Sorry about that. So what I can do is say show the sampled column, and then in here what I can do is I can pick 10 items from here, and let's say another 20 items from here. So now that I've broken it up into 2 different strata, after all the scoring that I've done, I can now kind of sample that. At this point, I can hit the sample size, and it stratifies it again. Bear with me. Whoops. But all I needed to do there, I'll put in the 10 here and the 20 below down here, and then I just hit the sample button. And what that does is it then sampled 30 items. Let me hit the finish button here, sorry. So it basically went through and took a sample of those top items from the 2 strata that I gave it, 20 items from the top, 10 items from the bottom, and then this is kind of like that sample of everything at that point. So this is kind of using active data, but also using scoring and stratification of that final score so that you can really kind of drill into that score and see where you most want to be focusing. Now, the last kind of section that I wanted to talk about today, and this is going back to that original Excel sheet that we had from before, and this is where we're going to get a lot of statistics in a few minutes here. But before I do that, let me just kind of quickly go back to the slides just to show you. So what we're trying to get to here is the normal curve and standard deviation and kind of where things are showing up within here. And this goes to that whole concept of, within 1 standard deviation you're at something like 60-something%, and 2 standard deviations it's 95, and 3 it's 99, and and again, without going too far into this, what we can then do is take a look at some of the major functions that you will need to know. And all of these are built into the schedule that I'm sending you, so it's something where you can kind of explore them on their own, but these are going to be kind of the 5 or 6 functions that you probably haven't worked with before, but are very useful. And then what we're ultimately going to then do is kind of go back into Excel. So let me go do that now and show you this particular journal entry scoring. So what I did here, and this is a little bit, of a different way of looking at it, but what I wanted to kind of show you is scoring at a transactional level. And again, we have a whole course on scoring, so it's kind of hard to do it in just a few minutes here. But what I wanted to say was, let's say you had a journal entry number, and for that particular journal entry, there were, say, 2 transactions, and those transactions showed up on the reports that we had from before. The way the score would work is that if, well, in this case, I'm sorry, we have 4, let me just show you this. We have 4 transactions for this one journal entry here. And we have a total score of a 0.56. So in all of the scoring that we were doing before, when we add up everything, they probably only showed up on like 1 report or something, like 1 transaction showed up on 1 report. Now, if you had a total score of 4 and you had 4 transactions, basically the score ratio of score divided by that would be 100%. But in our case, because it's 0.56 or 1.56 or whatever, you're looking in relation to those transactions, the score ratio is different. This is a way, and again, we'll talk a little later about some videos we have that could go more into scoring for you, but this is a way of now, before the scoring we did was on vendors. We had a scoring based on the vendor and if they showed up on a report. This is bringing it down to the transactional level where you're able to then say, well, how many transactions in that subset called journal entry number, how many of them showed up on all the reports? If we ran 30 of them, how many showed up? And that's that score ratio. All right. I wanted to kind of give you that perspective, but this could be on almost anything. It could be on value. It could be on total score, number of transactions, could be on all of this, but I'm going to then calculate on score ratio. So that's what I'm going to kind of focus in on. What I'm going to do is I'm going to try to build this normalized table, the bell curve. I'm going to try to understand where the items relate to the mean or the average and keep going here. And what's kind of cool, this spreadsheet actually calculates things at I'll say the proper way where you're actually like doing all the mathematics, but then there's some calculations over here like percentile is one, or this is normal distribution, this is this function up here, normal distribution, that automatically calculates it for you. Standard deviation, even though I go through this whole calculation over here, you just have to use the standard deviation formula and it does it for you. So it's kind of interesting. But okay, with that said, what I do is the formula, and don't quiz me on this, but I take all the score ratios that we had from before and we add them up. So I total the score ratio right here. Then I count up, so I use that count function on how many observations I have to get to the mean or average value, and that's placed here. So this becomes equal G4, which is up here. Okay. I believe there's an average function, by the way, that you can use, that you could just go equal average in this whole values down here, and it will do the same thing, but I've done it manually. Then what I do is I manually calculate the difference to that mean. So this score ratio is 14, the average is 12.3, 1.7 difference. I then square it. So, sorry for all these mathematics here, but I square it. I use the caret 2 to square that information. And then I divide it by the standard deviation. Now, how do I get the standard deviation? What I do is I add up all of, and that gets me to my z-score, sorry, but let me just kind of quickly go here. We take the total difference of those means squared. So this was the difference to the mean over here. This was the total difference squared, which is up here now, divided by the observations to give you the standard deviation, 4.82%. So it's 12.3 with 4.82% standard deviation. As I said before, over here, it's like 4.82 is the standard deviation formula that you can use to kind of calculate that. Okay, so I then calculate a z-score, again, all the mathematics here, by taking the actual difference to the mean and dividing it by that standard deviation. That gives me a z-score. And then that's the z-score formula over here, which is basically called standardize. So you can do the same thing, and you actually highlight the score ratio, the mean, and the standard deviation. So you have to have those 3 values, and it'll it'll basically give you a z-score. So, what is z-score now? In looking at it here, what it really is, when you look at the formula, is basically all the differences to the mean divided by that standard deviation. So it's almost like saying, that the average was 12. If I have a score of 45, I have a difference of 35. Well, how much is that off to, the standard deviation? Well, it's like, 4 or 5 times greater than the standard deviation. So it's kind of an interesting way of looking at it. My reason of doing all this mathematics, to be honest with you, at the end of it all, was really just to kind of get to this percentile approach. So if I can calculate my z-score, I can calculate the percentile. And the percentile is what I found to be kind of the most interesting of all of these, because this told me, kind of like what percentile was this value related to. So, when you looked at all the values and tried to look at the percentile, if you had, say, 15%, that was greater than 50%, because 50% was 12.3, so that's there. But this gives you an idea, so you start to kind of look in percentiles and want to, play with that. What I feel is, from an averaging point of view, you might want to, instead of just looking for values and stratifying it, you might want to actually go to this calculation and really look for stuff that's way outside the norms, like beyond, any sort of statistics that you would expect for that particular, particular transaction. So that's kind of the reason I'm showing this to you. Let me kind of quickly go over then to the journal entry score new, and all I did here was I copied and pasted from here this information. I just copied and pasted over here and just added on these 2 columns over here. So you just kind of got like I took out all that stuff in the middle because it was confusing. And I kind of got to this final, one. And, just kind of looking at it, it makes sense, when 12.3 is the average from before, when you're kind of looking at it, that, again, like 50%, so what you're looking at here is looking at that value, 34%, is it basically at 34% you are encapsulating like all values. There's nothing that's almost greater than these items. When you're at 20%, you're at 94 percentile, etc. And I really liked looking at it at the percentile level. Like, it made it a lot easier for me to understand where these values kind of fell in the normal distribution curve. Out of all the things that I've played with before, like mean and standard deviation and z-score and all that stuff, it was something where this made it, a lot quicker and easier for me to see. Let me just take a look here. So that, again, is kind of looking at doing standard deviation, kind of getting to that percentile. What you could do at this point is do a stratified sample even on the percentile, right? So that would be a way, instead of the way I was fumbling with it before. Let me just kind of get rid of this, and I'll just show you in active data here in taking a look at the percentile. What I can do is I can actually even select the percentile column and say create n bands, and I don't want to do that, but let me just kind of say create n bands, and we'll do 10, sure. So I don't even know if that worked right for me. Yeah, I'm not sure that worked right for me based on the calculation, so let me not do that. I was trying to get that into a stratified sample. One other thing that I wanted to show you with active data that I find really interesting, and it kind of summarizes a bit of what I'm doing here in this calculation, and showing it to you a little bit differently. Kind of gets to the answer a lot quicker, is what I like about this approach that I'm about to show you. If I use active data and I run statistics on the on this field, that's one way of kind of getting some statistics. But a better way is actually to summarize it, let's say, by vendor number. So now, I'm looking at things by vendor number and kind of getting it down to that level. I can accumulate the invoice amount and then include statistics, where I can click on that and include a variety of statistics. Let me, in this case, just click on the mean plus 3 standard deviations, and the standard deviation, is probably, or actually the population standard deviation. There we go. And then hit finish. And what this does is it not only summarizes by vendor, but gives you all of that information. And this might be another way to sample. I mean, giving you all these different ways. You could do it in more of a total for, you know, the standard deviation, but you might even want to do it by vendor. You might want to say, you know, which ones are mean plus 3 standard deviation, etc. And what's kind of neat about this, and I just bear with me 1 second here, is, bear with me, nope, I am kind of just missing it here, so sorry about that. But with that said, what you're able to then do is you could then relate back this standard deviation, basically the mean plus 3 standard deviations. You could VLOOKUP this value back to the original data. So you could say, you know, for that vendor number 1, you would relate that back to here and then relate it to the value by vendor. So there's a way then to say, well, you know, let me sample on items that are greater than 3 standard deviations to the average for that vendor. So it's down to the vendor level now and calculating statistics there versus being at more of that total level that we just talked about a second ago, which is way down here, where we were kind of calculating the percentile for the entire kind of subset of all of the transactions. This time we're kind of doing it by vendor and then analyzing it accordingly. Okay, so kind of going to our final polling question of the day. What Excel function is mainly used to organize the scores into a master score? This is going back to when we were kind of combining the spreadsheets together. Is it SUMIF, COUNTIF, RAND, or VLOOKUP? And so far I haven't seen any other questions come in, but feel free to post questions as they come in. I'll try to keep the polling open for, you know, just another 45 seconds to a minute here. Yeah, we're getting towards the end here of the presentation. Really just wanted to answer any questions you had, tell you about a few things and how to get like the files and the CPA certificate and CPU certificate and that kind of thing. But don't see any other questions coming in, but feel free to kind of post those as we go here. I'll leave the polling question open for another like 20, 30 seconds. Okay, I'm going to close that poll, share that with everybody. And VLOOKUP is correct. That is the function that is mostly used. Let me hit that hide button there. And obviously, any questions that come in, feel free. We wanted to kind of show you from an in the queue perspective. My gosh, sorry about this. In the queue perspective of looking at a few of the courses that are coming up soon. And have one in a little less than a month here, or a little more than a month, the Preventing Vendor Procurement and P2P Fraud. Then talking about journal entry with Excel tools in October. And then at the end of December or early December, we're doing a webinar on keywords. You know, it's actually a free webinar if you fill out the survey. So I wanted to kind of show you this survey as a next item as well. And the link's a little long there, but if you go to AuditrNet's webpage, let me just kind of bring this over to you. You can see the link. I know it changes a little bit, but it tends to be about right there, so right on that left-hand side. And what we're doing here is we're taking a look at all different types of keywords that people search on. Generally, people will you know, kind of focus in on FCPA or Foreign Corrupt Practice Act. You know, type testing, and you know, other than that, though, I think there's a lot to be said for just looking for financial statement type issues, just looking for kind of odd words that people are using. What I like to even do is actually summarize all the words in a data table, like just take every word that's an actual, you know, word, not a number or date, and kind of break it up into all the words, the components of those fields, and just summarize on that, and just see, what are some of the top words that are being used in the data file itself. It's almost like a way of figuring out, do we have a lot of payroll entries in here or accounts payable entries in here? You can just kind of summarize on keywords and figure stuff out. It's very interesting. But anyway, we're tabulating a list of keywords, and we'll then have a free webinar devoted to it. I think we're almost at about 200 people that have filled out the survey so far, and obviously
over 200
free,
people.
2CP webinar coming up. That is a good incentive, but we really look forward to the feedback, and feel that it's kind of a needed resource in the industry right now, is to have such a document of what are some of these things we should be searching on.
Rich?
Continuing on here, there was a free document that we noted in the beginning, how to use Excel as an audit software. I'm going to send that to you. That'll be in the files that you'll get. You'll get the 2 Excel files that we talked about today. Kind of showed you already how to get to this active data link, so I don't want to spend too much time on it. It's kind of like the best offer on the web, though, I believe, and if you're buying a lot, when you get to that point, I'm sure you could get a discount, but this is sort of for individual purchases, and I would urge you to, at least play with it for 30 days, if not more. I find it to be a very useful tool that goes way beyond sampling. I mean, sampling is one component, but there's just a lot more that product can do for you. And last but not least, there's audit software videos, which is a lot of free videos out there that you can take a look at. I manage the site now, working with AuditrNet, and what we've done is we've put a lot of our kind of old content into here, but it's still very valuable. There's an actual whole video series on scoring. One of the questions we have is, do you have any resources on 100% sampling? We're obviously we have a lot of webinars on like how to audit certain areas and just kind of how to do various different type of statistics in Excel and things like that allow you to do 100% auditing. You're kind of summarizing everything and then picking certain areas to focus in on and doing analysis, and that all is something that we're talking about in the videos. But we also are having some upcoming webinars as well that will talk to this, especially as we go into next year, and kind of talking on how to audit in certain areas. But with that said, it's kind of broken up into nice little bite-sized format as well, so that you're able to, just look at maybe just a component of how to build a pivot table or a graph or something, as opposed to having to watch like a 2-hour webinar on it. So it's a way to work on that as well. Other types of resources for 100% sampling, which is, again, is a little bit of kind of the antithesis of what we're talking about today. But I totally agree with the concept of doing more 100% type auditing. I think it's really even just kind of relating it down to the audit objective. So I know I'll take a really simple one, but if you have a duplicate payment control that says that you can't have the same vendor, invoice number, date, just run everything through a system that looks for that, and then if it kicks out any sort of deviations, well, you 100% tested and that control. And I think by looking at each of the controls that you're testing, and obviously the balances that you're testing, but the controls mostly is what people focus in on. But you should be able to figure out what are some of those reports that you could run that would give you kind of like a quick answer as to whether or not there's an issue. And I know that there's a push, and I showed that article from before, and kind of noted again as sort of it's nice to hear this stuff over and over a bit, but I've heard this for many years. Is that there is this push more towards 100% auditing and more data analytics in the audit function as opposed to sampling. So that's neat. And I'll just kind of note this was audit software videos. You just select the register here, which is down here. It's free. And by doing so, you'll sign up. You automatically get added to the mailing list as a note, so you can take a look at that. There's a lot here. We have a lot of webinars coming up as well to take a look at as well. But with all that said, I think we got through everything. It's about 12:57 or 8, so I think we're on time. And we do thank you. If you have any questions after the webinar today and wanted to ask from a technical end, I'm the best to answer. Probably from like a payment end, Jim might be the better answer if that is some of your questions, billings end. But I'm definitely on the other side of the technical end of it. So feel free to give us a call or email on anything. I do appreciate it. I'm just looking at our questions here. I don't think we have anything else. We look forward to your feedback. I know we send out an evaluation afterwards and do look forward to your feedback on this one as well. So, Jim, I didn't know if you had any final thoughts as well.
No, I think you've covered it all, Rich. Can you hear me? Rich, can you hear me? Hello, Rich.
And it may be
Rich,
me, but I'm not hearing your audio, Jim.
Can you hear me now, Rich? Rich, can you hear me? Okay.
Everyone else may be hearing you, Jim, but yeah, I'm sorry. But anyway, with that said, I think we're at our point here. I'm looking at our questions. I don't see anything else. We do appreciate you coming today. If you have any other questions, feel free to get back to us afterwards. Thank you.